Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist from Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with building the right portfolio. The China and Hong Kong markets have been the surprising outperformers in 2025. MSCI China is up 21.5% year to date, and the Hang Seng index reached its highest point since the end of 2021. This is taking place amid a number of challenges facing the Chinese economy. The US tariffs on China and the rest of the world are disrupting China's growth engine in exports. The correction of the domestic housing market and worries over local government debt burden continue. On the macroeconomics, China's economic growth numbers are actually surprisingly respectable. Its exports expanded by 7.2% for the first half of the year. While exports to the US was hurt by tariffs, exports to other locations were more than sufficient to compensate for this disruption. The economy expanded by 5.3% in the first 2 quarters of 2025, above the government's target of 5%. Various incentive programs by the government has helped to support consumption despite the weakness in the housing market. We have the Politburo meeting this week. We're not expecting much in terms of stimulus, but we could hear more about the government's direction to reduce excess competition in both manufacturing and the service sector. So all in all, the macroeconomic performance is respectable despite many challenges. But this also means the government and central bank could take a more conservative approach when applying monetary and fiscal stimulus in the months ahead. The prospects of stimulus was an important market driver in the past few years, and better than expected economic data used to be treated as a negative. So it is interesting that these strings of positive data did not dampen investor sentiment. So with me today to go through the dynamics of the Chinese and Hong Kong markets, I'm joined by our global market strategist, Marcella Chow, who recently wrote our On the Minds of Investors on this particular topic. So Marcella, welcome to the podcast.
Thanks for having me.
So first of all, why do you think the Chinese equity markets were able to perform so well in 2025?
Okay, so in the last few days, we saw positive headlines around the expansion of anti-involution efforts, with key focus on food delivering companies, which may lead to the cooling of the ongoing price wars. And these news were welcomed by investors, as this will likely help improve the supply-demand dynamics, ease the downward price cycle, strengthen corporate profitability by promoting healthier margins, and hopefully revitalize innovation. Similar anti-involution theme also continues to play out within the electric vehicle space. And this anti-involution campaign is another example of policy focus on mostly privately owned downstream emerging industries. This will likely further help boost private sector sentiment, which has improved in recent months as the significance of the private sector has been reaffirmed by senior policymakers. For example, at the recent World Economic Forum, or at the symposium convened by President Xi Jinping with leading Chinese entrepreneurs back in February, coupled with the introduction of the first ever legislation for privately owned enterprises in late April. Recall that this law actually aims to promote private companies and stabilize confidence and expectations for private business owners, aligning with the recent easing of regulatory pressures on the private economy. Additionally, China's antitrust and also M&A frameworks have become more transparent in recent years. Hence, despite the ongoing challenges on the macro and also geopolitical front, investor interest in China has actually been growing with measured optimism, which have led to increasing flows into both onshore and offshore Chinese equities.
So essentially, there's been quite a lot of changes when it comes to the policy front, and there's a clearer support from the government on private sector development, which was clearly a challenge back in the 2020. Maybe we split this into offshore and onshore market, and let's start with the offshore market. Yeah. What are some of the themes we've seen in Hong Kong and also the offshore market when it comes to Chinese companies?
Yeah, so even though broader consumer confidence, in a previous question we saw that private sector sentiment has been supportive by all those government effort and also reaffirmation from senior policymakers. But then broader consumer confidence actually only shows moderate improvement due to a sluggish property market, still elevated youth unemployment, and also ongoing income uncertainty. But then because of this, we saw that the nature of consumption within China has evolved, and new structural themes have emerged too. We saw that consumers are shifting their spending behaviors to be more rational, selective, and also value-oriented. Notably, we observed some new consumption opportunities that actually have led performances. In particular, the MSCI China Index entertainment and specialty retail sectors reached new peaks of 85% and also 57% respectively post-COVID reopening in 2023. And so we here summarize it as tea, especially as tea drinking remains as an integral part of Chinese culture. So what's T.E.A. tea? T starts with tech and globalization of intellectual property. So the technological breakthroughs by low-cost, high-performance Chinese artificial intelligence startup earlier this year, the unprecedented success of the domestic animated movie Naja, and China's innovation capabilities in drug development and biotechnology all point to the expansion of intellectual property, which is IP portfolios, product innovation, monetization, and globalization, which will serve as key drivers for China's IP development moving forward. We see that since COVID reopening, soft tech leaders and Chinese biotech innovators rallied 30% and 28% respectively. And year to date, they have also risen 20% and 56% respectively. And looking ahead, we believe ongoing AI development could further support the technology sector in the near term and potentially benefit the broader economy over the long run. As for E, T.E.A., the E stands for emotional value and paying for experience rather than pure functionality. So we see that consumers are increasingly willing to invest time and money in personal experiences that enhance emotional value. They indulge in small and affordable delights like blind boxes, plush toys, online games, cosmetics, and new snacks, which actually address stress and loneliness, providing comfort, instant gratification, and a sense of belonging to the growing Gen Z consumer group. As for the A from the T.E.A., the A stands for affordable luxuries, like domestic electric vehicles, smartphones, and hotel chains are actually gaining market share from premium global brands as consumers become more price sensitive in the current deflationary environment, emphasizing value for money.
Yes, indeed. So we've seen a lot of these trends in shopping malls, both in Hong Kong and also if you travel to China. A lot of these shopping malls are filled with shops that goes into this type of product. So definitely we see the growth there. But what you've mentioned here, a lot of these companies are listed in Hong Kong or in the offshore markets. Mm-hmm. What does that mean for the onshore market, the Asia market in terms of opportunities? Does it mean that all the exciting stuff is in Hong Kong and offshore and there's nothing really on offer in the onshore Asia market?
Not necessarily. Actually, onshore Asia market should still be the go-to market for investors that are seeking for stability through dividends and also policy support. So when global markets experienced huge volatility back in April with the tariff uncertainties, onshore shares actually demonstrated a higher degree of resilience. And this was largely due to stabilization efforts by the national team, which mitigated market volatility after the US tariff policy announcements. Therefore, onshore equity returns have exhibited greater stability relative to offshore equity in recent months, while still managed to deliver modest yet positive returns year to date. And this defensive nature for onshore equities actually extends to its abundance of high-yielding sectors and industries like energy and financials, which offered up to 6.7% and 4.8% dividend yields respectively, offering a way of dividend-orientated investment to compound returns. And there's also a push-pull dynamics at play. As onshore investors continue to explore various income strategies, these high yielders provide a sizable positive carry spread over Chinese government bonds, which have seen continued demand pushing 10-year yields towards 1.7% levels. This dynamic thereby serves as a pull factor for additional flows into onshore equities. Meanwhile, domestic regulatory encouragement for mutual funds and state-owned insurers to increase Asia investments, as highlighted in January's 5-measure announcement, also acts as a push factor for flows into the onshore equity market. Note that the July Politburo meeting will take place soon. Despite not market expectations, a continuation or expansion of the ongoing supportive measures will be beneficial to equity markets. And any surprise stimulus could also serve as an additional tailwind, making it crucial to monitor policy development.
Yeah, I think this is a really interesting point. I think two things. One is that if you look back to history, the onshore A-share markets, because of its structure, because of its company exposure, often have a low correlation with international markets, starting with the US. So that's actually quite a useful ingredient when it comes to constructing a portfolio. The second point is, I know a lot of investors have been disappointed by the market performance of China in the past few years, but the reality is, as Marcella mentioned, high dividend stocks, state-owned companies that seems to be more stable, but yet pay out good dividends, they have been very popular with Chinese investors. So their performance in 2023 and 2024 have actually been really quite good. So I think this again reiterates the importance of active management when you look at whether it's China or APAC markets or frankly any global markets. So it sounds like there's opportunities both in the offshore markets from a lot of these new themes, but at the same time in the onshore markets because of the policy support as well as the dividend opportunities. How should investors choose between the onshore and the offshore market when it comes to investing in China?
Yep, so from a valuation standpoint, both onshore and offshore equities remain relatively cheap when we look at valuations comparing to most developed markets. While the Hang Seng Premium Index is trading around 130, nearing pandemic lows, and are actually 5% below its 10-year average, this suggests a further relative attractiveness of onshore over offshore shares. But obviously, there are more factors to consider when investors choose between onshore or offshore equities. So from a portfolio risk perspective, offshore equities typically exhibit lower volatility due to a higher proportion of institutional investors, resulting in a more mature investor base. The sustained low Hong Kong interbank offered rate HIBOR and solid IPO offering pipeline should also continue to attract global capital inflows and enhance offshore equities performance for the rest of this year. Having said that, onshore equities are likely to receive stronger government support, like what you said just now, during systemic market drawdowns, as evidenced by the stabilization efforts in April. And from an investment return perspective, onshore equities provide access to a deeper market that better reflects the gradual economic recovery ahead, while offering a healthy dividend yield. And in contrast, offshore shares unlock exposure to all the dynamic growth themes in Chinese innovations, like what we mentioned just now, the artificial intelligence-led rally in February, the emergence of Chinese intellectual properties, the T.E.A. theme that we mentioned briefly at the very beginning. Both offshore thematic growth and onshore high yielders have demonstrated robust performances. But then it's important to note that this performance does not extend uniformly across all sectors and industries. Therefore, rather than making a clear-cut decision between offshore and onshore equities, investors could consider adopting a barbell strategy that balances thematic growth leaders with selection of high-quality high yielders onshore, and thereby allowing for the diversification of growth and income opportunities within Chinese equities.
So thank you, Marcella. I think that's a very interesting aspect where there are nuances both in the onshore markets where there's a lot more cyclical plays and that feeds into the economic recovery theme. But at the same time, in the offshore markets in Hong Kong and the US, you have a lot more growth themes, structural ideas that could provide good return to investors. So it's not a matter of either or. It's really using active management to pick the right companies in both markets that can help to satisfy investors' financial and investment objectives. So thanks for listening. If you enjoyed this podcast, please share this with your friends and colleagues, and also consider subscribing for more insights. If you have any topics that you want us to cover, please reach out to your JP Morgan Asset Management Client Advisor. I'm Tai Hui. I'll see you in our next episode to discuss what's on Invest Minds. Until then, stay informed and stay invested.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.